In today's tutorial, I'm going to be having a look at my preferred ways to make entries into the market. Today I'm going to be looking at my top 3 entries. Now this covers fundamental analysis, technical analysis, and combination analysis. To get right into it, we're going to start off with fundamental analysis. As a whole, it is a qualitative process, and it really does work off 2 different elements. There is the sentiment side of things, and then there's the bigger picture that we need to consider as well. It really does rely on you being able to examine the factors and forming an opinion about what is actually going on the global spectrum. Now, the data really does come from only a few different sources. We're looking at macroeconomic, industry-specific, public opinion, and of course, economic opinion. All of these in combination together will enable you to be able to look at different markets in different lights. So this might incorporate looking at stocks, futures, options, commodities, FX, and anything else that you might find along the way. Now, when we think about these things, they are, like I said before, the big picture or the short term. The short term really looks at more the sentiment or the emotion of the market, how people are feeling and behaving about particular products at that given time, regardless of whether that is a toy or if it is a stock or even if it is something that is going on a political scale. The bigger picture is really looking at things from a much longer perspective, but it does encompass a hell of a lot more. We're looking at things that might be incorporating what's going on a geopolitical minefield for a currency, for example, in which case we have to consider what's happening, not only the macro and the microeconomic, but also what's going on within that country as a whole and what some of their exports and imports might be as well. Now, moving on from that side of things, I want you to think about a couple of different ways that you can actually look at it. So I've given you a couple of choices here on how to think about fundamental analysis. The first of these are going to be heating futures. Heating futures, natural gas, oil, they all increase in value seasonally. This means, and it's probably obvious when I say it, that when we've got colder months of the year, more people are inclined to use the heating oil. So you can see the demand rise very quickly, and therefore the price rises to match the demand. The same thing happens with sugar prices. Sugar prices might rise when a season gets cut short, whether that be because it had plague, or they've had a bad season, or perhaps even the weather has just not been suitable to the conditions. This means that there is less sugar than there would normally be, and we might see some of the prices for sugar increase in value. The other one that we can look at that's been an example this year has been crude oil. Crude oil prices will fall if production is increased. And if those numbers are really high, then we can see events like we saw earlier in 2020, where we saw a price drop to negative $37 a barrel, indicating that due to the pandemic and also a case of there not being any transport and travel and some of these other factors that are at bay are enabling it to drop the price so low because no one actually wants to buy it. So that's some of the ways that we need to think about things. When it comes to currencies, we might, instead of looking at what's happening on that same fundamental scale, we might look at what's happening from central bank action. We might look at how rates or monetary policy is being modified. And those sort of things are all the more important to look at, particularly when you think about how many opportunities in a month you might get. On the major trading 7 pairs that you would anticipate, you would generally see that central bank action will offer at least once or twice a week, sometimes twice a day, giving us a number of opportunities throughout the month to try and forecast what might happen in the future. Now, looking at things a little bit differently, we have the technical entries. Generally speaking, you will see that they are limited in data. They are lagging information, and they generally rely on your ability as individuals to interpret price itself. Now, whilst we might look at the technical entries as being something that are related to price and time only, it's not the only matter that you can have into it. And the issue that comes with this, when it is on this side of things, is that everyone has a different personality. And therefore, the way one trader interprets the charts might be different to the person sitting next to him. But regardless of that, the data analysis really does come from either the charting type that you're using, perhaps you're using candlestick analysis, it might be line charts, and some will offer more information than others. There is also price patterns that you can tend to see in there. And there will also be your support and resistance, and of course, indicators at the end of the day to wrap it all up. Now, when I think about trading charts, this is usually what I don't like seeing. A lot of people that I tend to find that are learning to trade will try and load up their chart with a lot of different indicators, quite often waiting for their optimal moment to try and take a trade. And in some instances, that might mean they have 3, 4, 5, or maybe even 10 different indicators on there at once, which means they actually get less entries than they would like. And the reason behind this is that you might find that 3 of 5 entry or 3 of 5 indicators might signal for a buy position, but then by the time all 5 line up, because they are a lagging indicator, you don't get the accurate information for the exact moment in time that you need it. You really should have taken the trade when 3 of the 5 lined up, not when 5 of 5 have lined up, when price actually turns around and goes the other direction. It's also not something that you tend to see professionals using. We don't like indicators as much. You might see them on some quantitative analyst desks, but it's really more as just a go-to guide. It might only be 1 or 2 indicators that are looking there to give an idea of what's going on in price. So my general thoughts are not to really use charts that are over busy. It does also give you an issue with too much information, and you end up with a situation that you call information overload, where there are so many impacting prices or indicators that are going on that just don't measure up with one another. It ends up leaving you with a bit of a muddled position, or perhaps just unknowing idea of where things are going. So what I recommend to do is to actually start naked. And I don't mean it literally, though if you do want to do that, then by all means. But regardless of the fact that I'm looking at here, when I say trading naked or starting naked, I mean use a chart that doesn't have anything on it but price. The advantage of this is that you start to learn things about candlestick analysis. You can look at those individual patterns and then move on from there into a grander spectrum of things where you might see more than a grouping of candles that indicate a pattern together. It also enables you to look at your supports and resistance points, and also, of course, your swing high and swing lows, which will help you read a chart much better in the long term than any indicator is going to do in the short term. Now, looking at how we might use it as professionals, the one thing that I've seen in tier 1 firms, and being a part of a lot of them over the years, is that we generally just look for the support and resistance points, and we will look for those candlestick patterns or the things that match up. And realistically, we try and look for something that might have a little bit of news around it for when we actually do look for that point. So we might identify on the calendar about when a particular news event is going to occur, and then try and find a pattern that might operate in price around that point in time. And that gives us a better idea of where we might consider an entry. Now, of course, there is my third method, and this is what I do on a daily basis. And this is what I call the combination entries. And this is really when you get all of everything lining up perfectly. It's like the planets actually align. So in this instance, we're using a combination of both fundamental and technical analysis. In this instance, instead of giving you some charts or some theories, I'm actually going to give you an example of a trade I've done on my own. Now, the idea of this section here is I'm not going to give you guys an understanding on a single thing. I'm going to try and show you a worked example that I've actually conducted in my own trading career. The example I've got here is for you is Lockheed Martin Corporation, which is a stock. But the methods that I'm going to show you and how I've conducted it can really be applied to anything that you would like to deal with, whether that be FX, futures, options, commodities, or stocks as well, and of course indices and everything else of the like. In this instance, I'm looking at Lockheed Martin. Now, if you don't know, Lockheed Martin Corporation are an aviation company that do have some links to defense and military spending. In this instance, the position that I was looking at, the news was based off the idea of the F-35 fighter jet that you can see sitting on the screen behind me right now. Now, the process that I've gone through is pretty straightforward. I start off with a little bit of technical analysis just to have a look at what's going on, but I've gotten wind of what's happening in the news about what Lockheed Martin is doing and potentially them getting some cash flow coming in. So the first thing I did was have a look at what was going on the chart. And I could see that we had an inverted head and shoulders pattern. And this was after I'd already heard that there was some rumor of Lockheed Martin getting some level of a cash injection. So I had some idea of what might potentially happen, and then I've switched to my technicals from a fundamental view and put that technical hat on to have a look and see if something in price would match up. So in June 2012, I found this head and shoulders pattern, and I thought this might not be a bad opportunity. We've got the news that says this is likely going to happen, where they're going to get a cash injection, and then we've seen this next step here which says we think we have a technical pattern occurring at the same time. So I had a look at it and went for a de-risk opportunity by taking a very small trade just to see where it might go to begin with. From there, I've moved on and I've watched it all play out. The first thing that happened was the United States Defense Department confirmed orders of the F-35 jet after the rumor of them getting positive testing results at the initial onset of my trade. From there, we've had a rumor on what the cost might be, the build numbers, and the potential for a cash injection to Lockheed Martin of very big numbers. From there, we've seen a contract get signed, and we've had a cooling off period. So that means we were waiting for, whilst there's the cooling off period is in effect, they could pull out at any moment. But we're all a little bit more confident that they're likely not going to do that. Once that cooling off period expires, we then consider our position much heavier and we go, yes, let's work with that. The head and shoulders pattern is formed, we've entered our position, and we're happy to move ahead with the idea of what we're doing is a successful trade in the works. Now, the next steps that have happened here are real results of what have happened. We've seen from June 2012, and I held this position for 4 years until August 2016. Now, why did I actually get out in August 2016? The reason being was the project wasn't going as planned. They were over budget, they hadn't committed enough planes that were going through or manufactured enough to be delivered, so therefore we were seeing this likelihood of the second part of that contract, which was another cash injection to be fulfilled, was unlikely to happen. In fact, the whole reason I got out in this scenario was purely because I saw a little bit of a double top pattern occurring in price, which you should be able to see right at the very start of that August 26 box that I've got there for you. And in addition to that, we had a withdrawal on the total manufactured planes by the US military that they were ordering. So that caused another problem for us to have a look at. Now, regardless of that, this is how you should be thinking about things. You go through the process of looking for a chart that you might like. You consider what some of the fundamental news might be. Form an opinion about it. Then go and have a look in price again. See if you can find a pattern forming around that same idea on news and that opinion when it comes out. And then look for an opportunity to combine it all together to place a successful trade. My top 5 mistakes that I commonly see in trading. And I thought if I give them to you now, then it might mean less of an impact on you later if you ever identify that you're making these mistakes yourself. The first of these is misidentifying the phases of the market. It's really only trending up, trending down, or trading sideways, or as it's commonly called, consolidation. Now, regardless of what time frame you're looking at, you will be able to identify a trend of some kind. The issue with misidentifying a market really comes down to the play of whether or not you're looking at it from the right perspective. It is all about the big picture after all. So if you're looking at a trend and you might identify it in a 15-minute chart, be wary of knowing that it might be a retracement on a longer time frame. And the overarching idea of trying to get that change in direction might be contributing to you having losses. So keep an eye on, make sure you understand what phase of the market you are in at all times. Now, this one here being married to your position might seem a little bit odd, but the reality of it is it actually follows on from misidentifying a trend. And usually this occurs when you get someone who is in a position looking for a particular direction, thinking that it might be, say, an uptrend for the time being, and they decide that it is still an overall long-term uptrend. And they misidentify that phase, and then therefore their long-winded big observations end up being that they were really in the wrong side of the market. And quite often there's a lot of emotion that goes into this play, and it's not until after the fact, when we've closed the position, often for a loss, when we come back and reevaluate what's going on, that we really look at it and go, what was I thinking? So to combat that, we try and not get married to our positions. It's important to take a break. It's important to come back with fresh eyes and reevaluate your situation. If this sounds like you've done something like this before, then some of those strategies are really important to mitigate those risks, are going to involve literally just taking a break for a couple of minutes and walking away from the charts and coming back with fresh eyes on a longer time frame to really see where you're actually at in the market. The next one to look at today is about trading too large. Quite often we find that people over leverage their positions or simply don't understand leverage. You'll find that you'll be risking more than the account can actually handle, and you'll be attempting to recover from drawdowns quite frequently. Of course, we always get the issue with people trying to be a little bit more greedy than they need to be and having what we call hero trades, where they might be trying to recuperate that account because, of course, as we all know, if you have a 10% drop, it means you need to make 11.1% back to actually get back to break even, plus your little bit of profit you needed before. So we might try and load up on our position and take a bigger trade than is really necessary, obviously exposing ourselves to more risk, therefore a hero trade. Now, this one is very, very important, and it's all about how you actually treat your trading. All too often I see traders treating their trading as a hobby. They come home from work, they have a little bit of a flick and a play. And the reality is, if you treat your trading like a hobby, expect hobby results. You need to be treating it like a business. And of course, if you are treating it as a business, if you treat it as a part-time business, you get part-time results. If you trade it as a full-time business, you get full-time results. So it's very important to have that business mentality when it comes to your trading, because after all, we're in the game to make money. We're not here to play. So treat it like a business and you'll be a lot safer in the market down the track. The next one to look at is information overload. And information overload is something that you might end up in, information or paralysis by analysis. And this is something that you frequently find when traders use way too many indicators on their charts, or quite simply, they've read so much information on one particular topic that it becomes a case of there are so many compacting or competing ideas in your mind that you might find you're not quite sure which way to go. And this happens a lot. And even still to this day, I suffer from this myself occasionally. But there are solutions. The best of these is simply walking away, going and getting a good night's sleep, and coming back with fresh eyes the next day or even the following day, and reevaluating what is happening in the market at the given time. With much less information in your head and a little bit of a breathing break in between, it allows you to think a little bit more clearly. So that would be my gifting piece of advice to all of you. My top 4 exits. We're going to go through a couple of different ways or reasons that you might consider exiting a position. The first of these ways might seem a little bit odd, but it's actually exiting for a loss. Now, in this instance, as professionals, we don't like having losers. So what we aim to do is actually minimize our losses as best to capabilities that we have. We can't obviously have losses all the time, and we can't avoid them entirely either. So quite often you'll find that people do try to avoid them entirely by mitigating or managing the loss as it goes down further into the red. Unfortunately, this doesn't always work. So it's more important to cut off your positions earlier in the piece and let your winners run. So that way you end up making profit in the bag. Now, of course, the idea of cutting off your positions early also indicates to another matter of piece, which is not getting married to the position. So if you do have a trade that you get into and you do think it's going in the right direction, but it's not actually resulting in you actually being profitable, then it's probably the wrong trade to be in. So regardless of that, if it's the wrong trade, it's just simply the wrong trade. Cut it off early, don't take the loss as big as it could have ever been. Looking at the next one to look at is time-based exits. So this is when you might find that an expectation that you may have had for a trade hasn't been met. So I like to set a time limit. Let's say I'm placing a trade on a double top or a triple top pattern, and it hasn't resulted in the price action that I thought was going to occur over a reasonable amount of time. I might be looking at an hourly chart, and I've found that over the last 3 or 4 hours, it hasn't actually resulted and price has just gone sideways. If this is the case, then my plan would be to close that position, because naturally, whilst the criteria was right for the trade and it suggested that this was going to occur for a profitable position, it didn't end up happening. And so therefore, I have to reevaluate the situation and consider closing that position regardless of whether it's in a winning scenario or a losing scenario. Now naturally, all of these things are conditional. If the entry criteria is no longer valid because you've had time elapse, or perhaps it's ended up going in a different direction to what you initially presumed, then the chances are it's probably a good idea to exit. So much like exiting at a loss, a time-based exit might result in a little bit of profit, but it could also result in a loss. Either way, it is better to get out earlier rather than later when you're not quite sure what the market conditions are anymore. This one is exiting at a profit. It may seem obvious, but there's a little bit more to it. And you might be saying, well, Alistair, isn't the whole idea of the game to be trading for money and to be making wins on the board? Yes, you're absolutely right. But there's that little bit more to it means you need to have a reason for your exit. There's no point getting into a trade if you're not quite sure where it's going to go. So obviously, if you're not sure where it's going to go, it could go anywhere, which means you might end up exiting at a loss instead. Important measures to make are having that expectation on what the actual distance is you're going for. If you don't have an idea or you don't have an estimation on where you think price might be about to head, then a good way to get around this is to use something like a risk-reward ratio, where you can have a set fixed take profit and a fixed set stop loss. Now, obviously, you need to be a little bit flexible with your take profits because you might want to let that trade run for a lot longer than you anticipated. So naturally, have a plan, but it's important to still remain flexible. If you don't have an ideal target, move back to the risk-reward ratio idea. If you don't want to use that either, try and use something like a trailing stop where you can just trail it up behind price as it moves along. Naturally, you might consider using something like 30 pips behind price, and every time you get a new swing high, moving that trailing stop up with it. Of course, you can use indicators as well if you're not quite sure. Something like an ATR stop, or even a simple moving average at different times with a longer time frame on it. This might help out a little bit. Some little strategies that might help you find the ultimate position for yourself to eliminate some of those positions you exit at a loss for. Out of all the strategies that I've shown you today, this is probably one of my favorite. It takes a lot of the decision making out of the process for you. And keeping things really simple in trading is absolutely important to help you focus more on the market as opposed to what you're actually doing. It's one of the reasons that trading plans can be so effective. It means that you don't have to think about what your next actions are going to be. Letting the market pick the exit for you, however, allows you not to have to worry about where you're going to be putting that take profit, or if that risk-reward ratio is accurate, or even if it's been too long a time since you initially decided to enter the position. It allows you to employ a trailing stop to maximize your returns. And you don't need to worry about if the price gets closed out, because that's the whole idea of it, triggering the stop loss and allowing the market to exit the position for you instead. Now, one of the important factors when it does come to using this is that you need to let it breathe. Whether that means you use a trailing stop that has some level of pip variation, whether that be 30 pips and then moving it up to each swing high, or if you're going to use an indicator such as an ATR stop. Either way, whatever solution works for you the best is going to help you maximize your profit and let those profitable trades run.